And to be honest, I get it. A lot of people were investing out of state because they were getting higher returns, like not necessarily building equity or the appreciation, but they were getting higher, like just cash flow more.
Yeah.
But if you talk to anybody that owns in Texas now and some of these other places that were well known for being cash flow states, it's changed. It's more like California.
Yeah.
So now you're, now you have to buy deals and like look at the upside, and maybe you're not going to get as much cash flow, but you're going to get more appreciation. Like they're all dealing with the same type of investments now that we are. So now I'm like, I'm not going out of state. And then plus I realized like, yes, I want the cash flow, but you cannot beat the appreciation that we get here.
You cannot.
Hands
and that's
down.
never going to go anywhere long term.
Right.
Yes, it might go up and down in the short to midterm, but if you can buy well-located assets anywhere in coastal California and hold them for 10, 15, 20 years, you're going to make more money than God. All right, welcome to another episode of The Reports. Today we are in for a treat. We got two of my favorite people here in the brand new podcast studio. First interview in this studio. Two of my favorite people in the industry, got Kenny and Krystle Simpson. Welcome to the show, guys.
Thanks for having us.
Thanks for having us, Rich. Love the setup.
Of course. I mentioned it to you guys during the holiday party here last month. I was inspired when I went on your guys' podcast back in the summer of last year. Kenny and Krystle have a really nice office here in Mission Valley, San Diego, and they got their own podcast studio. So when I went on their show, I was inspired. And so thank you for that.
Thanks. You're actually inspiring us.
Yeah,
now.
I'm kind of jealous of your office. I was like, man, I like this office better.
Yeah, absolutely. So there's a lot of talk right now with economy and what's going on with the Federal Reserve and interest rates. So I want to dive into that. What are you guys seeing on your front right now with interest rates and everything in the market?
Well, I mean, for us, I think what we're anticipating is that rates are going to go up more before they start heading the other direction or just take a pause. So we're kind of anticipating rates will go up. Maybe there's going to have to be some kind of an increase in cap rates. But it's like, that said, at least for my side of things, which is commercial, I don't see that it's going to be like this massive, that's not going to be 2008. That's just not, I mean, we actually didn't have that situation even in 2008 for commercial, at least here. So I don't think that it's going to be huge, massive drops in value. I think it's for a period of time. And as long as you're not selling your building at that particular time, you're not going to experience any kind of loss, so to speak.
Well, it was interesting because if you go back a couple years, we had the pandemic that dropped in early 2020. And for a few months, everyone was like, oh my God, everything's going to come down. This is like this is the end of this run. And everyone was kind of sitting on the sidelines, just kind of waiting. But then the Fed started printing money. They started hammering the rates down, and they are printing stimulus checks. And then next thing you know, there was all this money, and then people were like, oh my God, well, if the whole world shut down and there was no recession, the Fed did not allow it, and now they printed all this money, 40% of the money supply, I'm going to start buying some real estate because we're going to start seeing a bunch of inflation. And then we saw a big run in 21, and then early 22, what was it, like February of this year? I remember doing a hard money loan for my Scottsdale property. It was 8% interest only. And that was, I think, January of this year. And then shortly after that, the Fed just came out and started doing these rate hikes. I mean, did you guys anticipate these massive hikes month in, month out? I mean, 50, 75 basis points, another 75, another 75.
Nobody did.
No, I mean, definitely like what you just said. We've been living in interesting times, right? It's like, so we can look at a couple of things, but when we're talking about rates, if you go back to, I was saying this, I think in maybe a podcast we did or with people, if you went back to November of just this, 2021, the Fed said, we're thinking we're going to basically hike the rates 75 basis points for the whole year. That was their prediction.
Yeah, and they said inflation is transitory.
Exactly. So I think the problem here is, that's what I tell everybody. I said, the Fed came out, so June of 2021, that is when we started seeing inflation hit like 5% CPI. That was the first okay. But at that point, the Fed probably should have pulled back a little bit, but they all thought it was this is not going to be forever. And so they just kept hitting the gas pedal. And so what happened now is now they're slamming on the brakes. For the people listening, it's like, I always tell people, money in, money out. Like you just said, they're putting money in, whether it's the businesses to individuals, it's vetting you visas. I don't know what they're doing, buying mortgage-backed securities. And now breaks mean they're trying to take money out of the system. And then everybody's like, well, where is the money? Well, you can basically take money, like, so banks have options. Banks, like Krystle's bank, they can go do a commercial loan, or they can say, well, I can just go park my money at the Federal Reserve. It's the Federal Reserve. There's no risk, there's no underwrite, there's no nothing. And they're paying close to 5%.
That's insane.
So if you look at anybody that is a Wall Street guy, big investor, anything, they can go do the same thing. They can now go put their money in a 3-year treasury, right? A 2-year treasury. And then they're like, well, how'd they get it out? Well, you can go borrow 80% of your money out of the treasury at a rate and go deploy it. So if you're in a volatile market, people are like, I can just, when it comes to capital and deploying it, they'll just like, I'll just sit on and park it over here. But while all this is going on, but this is where opportunities arise, right?
Yeah.
So, and I just think that just like the supply chain, that's not helping inflation. Everybody was, cooped up. Then everybody came out of their, home and said, I got to spend money. I got to go on a trip. I got to do a VRBO. I got to go, and then basically we were behind. And so by Christmas time, there's almost $1 trillion of excess supply sitting on retailer shelves that they're like, oh, whoops, we kind of missed that. And so that's why you're seeing retail was strong, but I'm like, yeah, but they weren't making money because they're selling, it's a discount. So as I tell people, if you got to go buy new stuff, this is a great time. They're selling everything. You got to get rid of it.
Yeah. So these rate hikes that we're seeing, I know it slows down, investors, and it slows down opportunities in the investment asset classes out there, real estate as well. But in terms of all the inflation that we're seeing in the food chain and all these other products within the world, is it helping with that? Is it helping the average, everyday, lower middle class person in America, these interest rate hikes? Is it helping them out?
No. And this is the thing is, we'll go back, we're here to talk about real estate investing.
Yeah.
This is exactly why if you never knew what inflation was, you didn't understand inflation, you understand it now, right? So people that's why we realize the wealthy why is not because they have cash, it's because they have assets. The cash in the bank is not making them wealthy. It's the real estate. It's it's all the investments, right? Going on. I mean, the stock market's down, whatever, but real estate relatively is doing well. So I think the average lower class person is getting crushed because they don't have much money. Their gas, their milk, their food, their rent has gone up, but their paycheck hasn't gone up.
And not to mention now they're worried about if they're going to still have a job,
right?
Because we're kind of anticipating a lot of layoffs here at the beginning of the year, which is very realistic for the market. But it's also like a necessary thing that we have to go through. Like we have to go through this pain to get to the other side, because you can't just keep going the way that we were.
Yeah.
And that's what got us here in the first place. So it's like, okay, we have this little period of pain. If everybody can make it through that, then we'll start reaping the benefits. Even if the Fed says that there is no plan to reduce rates, they also said there was no plan to really raise them more than 75 basis points. And then if you look historically over the last 4 recessions, every single time the Fed said that they weren't going to drop rates, they inevitably dropped rates. Why? Because they're going to stop the economy now or significantly slow it. And then they're going to need to stimulate it again.
Yeah.
And so it's just like this
it's
kind
just
of
money
cycle.
in, money out.
Yeah.
For the average person, it's money in, money out, right?
Yeah.
And so now we're 2023. The Fed went, so I shot a video about 5 pivots. First pivot is language. They went from bullish to a little bit hawkish. Then the second pivot was 75 to 50. And then you're going to see those pivots 50 to 25. So the point is, the only thing he cares about is not us. It's the people that can barely afford life. He's got to get inflation down for them. So as soon as that gets cooled, so that's like gas is already down here. Look how much gas has come down for us.
Yeah.
Holy smokes.
That's true.
A lot.
That's true.
So inflation comes down and then basically everything corrects. Like Krystle said, the job market correction, but they're thinking 4.5%, 5% unemployment. So that's 1 million, 2 million jobs. A lot of the jobs you're going to see get hacked though is you can imagine, look at the tech, they way overhired.
Yeah. How accurate are these job reports though? Because, we see these reports come out, but then I'm also hearing of a lot of people I know personally that are getting laid off at their companies. And so how accurate are these job reports?
And honestly, I think we got to get away from the holidays because there's a lot of temporary, like, the January,
Seasonal
December
workers.
report's
Yeah.
good. I'm like, yeah, but how many temp workers do you hire?
Right.
How many seasonal workers were
So
there?
we got to get away from. We got to get away from Christmas because that's the booming retail, that's the booming travel, it's the booming spending, and the Fed is looking at that. So we need to get in the next. That's why the next 60, 90 days is good because we're getting away from that where the job reports are like, this is real. It's like, what are we looking at? So that's why the jobs report on Friday is coming out. The first one we'll see, but I don't know if the market's like buying it, like you said, because Wall Street's like, are these really valid? Are they real? Or what's going on? So I don't know. I think there's it's just a lot up in the air, I think, till we get over the next 60, 90 days to get away from this holiday season.
Yeah. So this last Fed announcement in December, they said, hey, we're going to do another 50, right? Yep. What do you guys anticipate as we get into the next few months? What are you going to see them do with these rate hikes?
He's thinking, well, the on the tables are, he's thinking a quarter and a quarter.
Okay.
The job report will matter. Like, it's really inflation driven will matter. But I mean, we were shopping around the malls, and I love to ask everybody what's going. I love asking what's going. Yeah, me. And so, we're in Nordstrom's, big, and UTC. A lot of people go there. The store. We all know the store. I asked the guy in the men's, how's it going? He's like, and we're just off this year.
He said, we've been
we
waiting
haven't
for
got
this
the rush.
rush.
And I'm like thinking, well, when is the rush coming? We're out of time.
Yeah.
So I just don't think we're going to see, I don't think the rush came. We talked to another guy where I shop at is Scotch and Soda and Fashion Valley Mall, kind of a niche thing. He says, it's better than I thought, not as good as last year, but he's like, I mean, he didn't hire the seasonal workers he thought he should. He's a little bit busy, but he's like, it was not like last year. So I don't know what we're comparing it to. So last year was crazy. It's definitely coming down. So I think the consumer is slowing. So if you take the pandemic, all the money that got deployed, there's about 2.5 trillion in savings. And then there's about 1.6 trillion in savings now. So people are burning through the savings or the credit cards and stuff. So that's why I think as we get closer to this pivotal point, it's like the Fed's going to have, something's going to have to make.
They can't keep going with the rate increases.
Yeah.
I mean, it's already like record increases. But historically, the Fed overdoes it, right? They swing too far in both directions.
Yeah.
So he's, in my opinion, he's already swung too far with the rate increases. And a lot of people, other economists and professionals and things have that same opinion. So it's like he's going to do the exact same thing. And they're going to be like, "Oh boy, we better hurry up! Now we're going to have to drop rates because
or
have we even felt the rate hikes? Have we really felt them?
Right, because there's a lag period, right?
Yeah, and that's what we're saying. So I think the one thing that we can just admit that Jerome Powell said that really matters, and it is right. He's like, I'd rather go too far. Because if I go too shallow and it goes back up, then we're in the 70s and doing this game, which we don't want. But if I go too far, he even said it. Remember when COVID hit, when you started the podcast?
Yeah.
I can drop rates. I can drop the hammer. I can put money. I can put money in this system quick. So he'd rather go too far and go, okay, I got to deploy capital. I got to get it moving.
Sure.
And that's what they'll do.
And I think this is not a bad position to be in, because if you look at the other side of the coin, if we were in this position and things were slowing down, but rates were still low, then what else do you have? But with this massive interest rate lever, the supply demand fundamentals within real estate across all markets in America are still very strong. And so I think whenever this does reverse course, there's going to be a lot of opportunity, and we should be in for another ripe run. Would you guys agree?
Oh, for sure. Yeah.
And look, like, for the most part, like, obviously there's like these boom and bust areas and, certain places that struggle more, but we are well past the boom in the last boom. So 2008, pre-2008, prices have doubled or something. It's crazy how much equity people have made.
Average equity in a home is 300,000.
So that's the thing. It's like,
what was the average equity in 2008? Like, but right when the crash was happening.
Well, I'll tell you this. Let's talk about 2008, right? So I always tell people I don't even give opinions. Let's talk data. 2008. Let's take San Diego.
Okay.
Right before the crash, Monty, how many listings we got? 3,000 listings right now. Okay. Let's say a crash. Let's just tell everybody, cool. Let's say a crash is coming tomorrow.
Okay.
Last crash, 27,000 homes on the market. Everything.
there's no way we're
just
gonna
stop
get
and think about that.
3,000, 27,000. And this is just San Diego alone.
Yeah.
Holy cow.
Exactly. Number 2 data point. When we went into the recession, 28% of homeowners were already underwater. Maybe there's 3% now.
Because everyone has equity, right?
Yep. Third big statistic that is, I don't know if this is a fundamental thing or the banks have learned, but one of the things the banks really got screwed on is the foreclosures and the short sales. It was really disruptive to their business. I always tell people banks are not into the foreclosure and short sale business. They're terrible at it. It was a nightmare disaster just from it took 8 months to close short sales until they figured it out. They just were such a mess.
Yeah.
And that's not their business. And so at the 2012, it wasn't even the peak. 34% of deals getting done across the nation were from a short sale or foreclosure. Today, it's not even 1%.
That's crazy. I remember my first real estate home that I bought was in 2011. And this property had just sold in 2008, right when the crash was starting to happen. I think it sold at $575. And I was able to come in and pick it up at $275. This is in Palmdale, California, when I was working the ATC job. So that's crazy. So this time around, what do you see different? Learning to become a successful real estate investor can take a lot of time and dedication, which some people just don't have. If you're one of these individuals, this doesn't mean you can't invest in real estate. My company, Summers Capital, is buying a bunch of boutique hotels right now, and you can invest with us in these deals without having to do any of the work. Our team sources the deals, we secure the lending, we take care of all the renovations, and we even handle all the day-to-day operations with our in-house management company, making it truly hands-off and passive for our investors. If you want to learn more to see if we can help you, go to summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
And then let's get into the difference.
Yeah.
So we're in the mortgage business. So we called it the heartbeat and pen loans, but let's just say what it is. I think there was in the high 30s or 40% of the loans that were done right before the recession were on adjustable rate mortgages. And when I tell people adjust rate mortgages, it's not the ones we have now. It was neg-ams. A lot of the average teaser rates. So you might have had an arm that was like a low arm for 1 year, then it adjusted high. So let's just say they were terrible loans. And most of those people were probably not even qualified for the loans. And so 97% of loans that get done now are done through Fannie, Freddie, FHA, conventional. Those all qualify full doc.
Yeah.
Not to mention, you could get like 105% loan to value.
125.
I remember
105%
No,
LTV?
125. There's lenders going 125%
125%
CLTV.
Holy cow.
Yeah.
So they were already underwater, and then they went more underwater when the recession hit. So they're not doing any of those loans today. Like people are very qualified. I think the least qualified people are maybe FHA buyers that are putting 3.5% down.
Right.
That is probably one of the higher risk loans, but they're still qualifying, and they've gotten more conservative even since that time. So it's like they're doing much better quality loans.
Yeah.
So people might want to move and they can't move because they're like, oh, the market sucks. If I sell my house, the rates are so much higher, I won't be able to afford. But now at least you can just stay in your home and you still have some equity and you're not underwater.
Yeah.
And we're not dealing with all the foreclosures and all of that stuff.
So here's the difference from last time and this time is the average person has equity. The 92% of all mortgages have a 5% or less. In the 70s have a 4% or less. And I think it's in the 50s and 60s have a 3% or less fixed rate.
Wow.
So even if somebody is struggling or this or that, they've got a really low rate. So a lot of people can be like, hey, I'm going to sell my house because I got equity and I need to get cash out. You could just assume my FHA mortgage and come in with the money at 2.25. That's what you're seeing.
And that's very appealing for the next buyer.
Exactly. So you're seeing a buyer going, okay, well, that's a great mortgage. I can come in with the money. I'll assume it. And then for the seller, they're like, I still have some equity because I made it. I can get out scot-free or have some equity and I might have to go rent or something.
And go rent, yeah.
So there's going to be, when there is no options for, there's a lot more options. And then
That's a really great tip, though. You kind of like just graze over it. The fact that somebody can assume an FHA loan, like that's huge because most agency loans or residential loans, they are not assumable. So that is huge that you can come in and assume the loan.
Yeah, I had no idea until now that you can assume an FHA primary residence mortgage.
Yeah.
That's insane.
Yeah. Like, so this is happening. And then, on top of that, nobody's ever said this. I kind of came up with it in my head. And then, when the banks went through the foreclosure and short sale process, so when COVID hit and they said, hey, we're not going to screw up your credit, that was probably an entitlement thing for people. But what it does is, what I think the banks learn, and I've never really heard this talked about, but I can know what it did from like us doing loans, is somebody, the big recession hits, something happens to your business, and all of a sudden you're like, I can't make my mortgage payments. So you'd call them, they're like, sorry, there's nothing we can do, Rich. You're like, what? There was no workout this, because they didn't know. Where you're just gonna have to take a late. Well, what you did, what the government and the banks, they don't say it, but what they did is you took all these consumers and you destroyed their credit.
Took a buyer out of the market.
So what happened is Rich is like, well, Kenny, I rebounded in a year. My business is back. I got my back on my feet. I'm rocking and rolling. I want to buy a house. I'm like, sorry, Rich, you're going to have to wait
Was it 7 years?
What? Or private money. What you did is you took a bunch of people out that couldn't get car loans, credit card debts, so you knocked the consumers out.
Yeah.
That, I think, extended this. So what they did this time, they're like, if we let people do this, what we're going to do is create a mass amount of shitty credit, non-consumers. And I think this is why they learned. They're like, isn't it better to try to extend their loan out or work with people? Because we're not in the foreclosure or short sale business. And I'm not saying that's the reason, but there's a reason why they did this workout with all these people.
Yeah. That's crazy. So I wonder if there's an opportunity out there for a savvy investor to go identify people that are short on cash right now that are in FHA mortgages that they can assume.
Absolutely there are.
There's a who it is. Pace Morby is all over it. Yeah.
All the stuff.
So we were on with a Zoom with him, and he was just saying he's doing VA, FHA. VA's hard because they have to give away their entitlement. So what he's doing too is some people bought and if they sell, they might have to come in with a check for 20, and he's kind of like, hey, I'll assume it. Yeah. And because it's so low, I can go rent it for zero money. I'll assume your loan. I'll take you out of it. Nothing. Your payment's $1,500. I can rent it for $2,500. I'll sit on it. The economy will come back, and I'll just cash flow it. Yeah. So there's opportunities.
Yeah. Even if you're breaking even cash flow wise, it's like, hey, long term, it's still going to be a nice play.
There's a whole group of people doing this.
That debt, you're paying down debt so fast,
Yeah.
The thing is that like there's definitely a market for that. It's a completely different approach.
It is.
So you kind of have to learn. You really have to learn that, and all the best way you can learn is just by getting in and doing it. So you're having to talk to sellers and negotiate with sellers. So you have to learn what they want to hear. You have to massage. Like it's completely different because you're not negotiating with agents or anything like that. You were talking direct to sellers to negotiate, and those deals are out there. It's just a completely way.
I got an email 2 weeks ago. Hey, Kenny, do you know how to get a second behind a VA first? Because I'm assuming a loan at 2.25, and I was kind of like, call your, Navy Federal or something. He's like, okay. Because he's like, he wanted to put minimum down. So he's like, how high will you leverage it? Because he's like, I got to put money down because, if they owe 400, it's worth 500. You got to meet it. But it's like, if you have the money, 2.25, I mean.
Yeah, you can't beat it.
It's probably 5.5 today, 3%, significant difference.
Yeah, you can't beat it. So you guys were in the mortgage industry during the 2008 crash. What was that like?
It was... I don't know. It was wild. Honestly, it was just doom and gloom though, like everywhere. Just everybody's losing their houses and everybody's, this is where I think a lot of people got jaded on real estate is just because everybody knows at least one person that was completely
wiped out,
blindsided, more like
just wiped out. And so then, they had this opinion of real estate, but I think there were a lot of lessons learned there too. Like people are making a lot smarter decisions. I mean, during the boom, I was doing business with real estate investors that were literally just buying properties because they're like, well, it'll be worth more tomorrow. Yeah. Like that was the mentality. You didn't it's like we all think we're experts, right? Like when the market's going up, we're like, oh yeah, I'm a pro. Right. Like I know exactly, I'm the best. Yeah. And then you realize that it was the market working for you that time. So, and then all these people got hurt and now they have to really think about what they're doing. So my perspective was completely different than what Kenny had with like homeowners. So I didn't have that as much, but I had a lot of partnerships going bad and like construction projects going under and banks not funding on construction draws and things like that because they were going under. So we are starting to see some of that happen now. Like the construction sector is probably the most volatile right now, or the most kind of risky
for
right
massive
now.
deals. Yeah.
Just
Like ground
because-
up construction.
Yes,
Yeah.
ground
The
up
long
construction.
projects.
Yeah.
Yeah, because think about it. Banks are all about safety, right?
Yeah.
And security. So now you're doing this ground up project and you have to foresee what's going to be happening in the next year, 2, 3. And they don't want to deal with that in this market. So they're like, yeah, we don't really know what the outlook is. So this is where like I'm seeing people looking for construction loans, but I'm like, hey, I've seen this. And we talked to a very big apartment owner who's worth more than most, and he's already not getting his construction draws. And this is a guy
Big
you
time.
would give
Really?
like so much money to, there is no worry. So he's having an issue on one of his construction projects. So for me, I'm just like, okay, this is a sign of the times that banks are like, it's not safe right now. We're going to scale back a little bit. So just because you have a construction loan doesn't mean you're actually going to get your draws. So the banks do have the right to do that.
That's crazy. So if you have a private money loan or any sort of construction loan and you're getting draws to fund your project and they already agreed to everything, at any point they can say, hey, we're not going to fund anymore your
Yes.
construction. Wow.
Yes.
That's crazy.
That's why you want to make sure.
But don't they feel like in order to fund the rest of the project to get it to the finish line, that's their best avenue to get their money back
But
from
think
that
about
investment?
it. If they've got all these projects and there's guys underwater, there's guys that went over budget, they're asking for more money, like all these things. So you look at your portfolio as a whole and you go like, we're not so healthy in this department. Like we better cut it off before it gets any worse. And
Or
so,
scale back. Or
so we ended up doing new construction loans to take out old construction loans also. So, and that's always a mess because title and, all these other things, it's a mess. But that happens, like where the bank's like, sorry, we're not funding anymore. So, and there's a lot of banks like during the boom that get into construction because they're like, we're doing great on everything else. Let's do construction.
Yeah.
And then they realize like, oh shit, this is a different animal. Like this is a completely different animal. So I would say that you're safest with the banks who have like been doing construction for decades. Like that's their
Track
business.
record.
That's their primary focus. You're much safer with those than to go, you went with the guy who was a little cheaper, but they've been doing construction loans for 2 years. And you're like, they probably are going to have some bad projects on their books.
Yeah.
Like construction is notorious for that. So I would say that's probably like, all the different sectors in real estate have different risk profiles now, especially in times like this. Like, for example, if you want to buy self-storage, that's probably a fabulous thing to get into right now. Multifamily gets better. Why? Because people have to stay renters even if they don't want to. Hospitality, like there's a lot of hotel owners who are just tired and haven't improved their property. So there's a lot of opportunity there. So there's a lot of opportunities in the market. Just because we're in a quote unquote recession and in a downturn, it doesn't mean everything's in a downturn.
Yeah. I'd be curious to hear your guys' opinion on like where you guys see the most opportunity in 2023, like just with the climate that we're in. I think right now, for me personally, like to be a buyer right now, what I won't do, what I don't think anyone out there should do in a time where everything is kind of softening, is to buy something that's turnkey and pay market value and buy a product that you can't add any value, right? And so I think for me to buy right now, we have to buy something that we can pick up at a discount, something that we can add tremendous value, because that's going to give us a cushion and a margin for error should the market continue to soften, and it likely will continue to soften before it gets better.
Yeah, I agree. And there will be a time where, unfortunately somebody will, well, I agree with you, but I do tell people if you're buying let's just say primary residence, right? Mm-hmm. It's a good time to maybe buy it from a flipper because if they bought it at the peak, and I tell people they're like this, I go, let's just do the math.
Today.
The guy bought it for $1 million.
Are you really? Nice.
He put 200 into it. And now he's going to sell it for 1.5. Now he's selling it for 1.1.
Wow.
He's writing a check. We know this. And they're like, no, I'm going to get a deal. I said, so what are you going to buy? You're going to go buy something for 900 and you have no experience and you're going to, this is a done deal. The guy's giving, like you just got a gift. He did all the work, all this. This is what he does. You're getting a retail product at a wholesale discount.
Yeah.
Those are there because housing moved faster than a commercial or something. But in the future, like Krystle said, there might be a developer or something that keeps going down the road and they get cut off. And that's where these big guys come in and go, well, you're 80% done. I'll take this off your hands. And that's where they went. Or there was people that built the project and they couldn't get the takeout financing because of XYZ or their credit or something, and they had to sell it. And they did the retail job and you're paying wholesale, and that's where you win. But right now, like you said, in this market, I only see the single families that opportunity, the flippers, or the open doors that need to like get rid of this stuff that shouldn't have been in the business. Like Krystle just said, they're in the business for we're going to flip homes. You're like, so you just started this. It's just like the guys that are doing construction lending. Oh, you guys just started a construction lending arm 2 years ago? Wow. Okay. Well, I'm working with somebody this bank's been doing it 50 years, and this LO's been there for 20 years, or chief credit officer. So it's who you're working with. But I think the opportunity for first-time home buyers is definitely assuming loans or getting those good discounts, or maybe picking up a deal from a flipper. I think we'll see a lot of opportunity across the country for that. And then also too, I think San Diego right off the bat, you'll probably see in the 2 to 4 unit opportunities to pick up deals. And I don't think with Krystle it's quite there yet, because people don't have to sell as much. There's cash flow.
So like, just to piggyback off of what you said, like, actually for me, I only want to buy value add in any market, whether it's a hot market, whether it's a down market, whatever. There's always got to be like meat on the bone, so to speak. So that is just our strategy. And now obviously there's varying degrees. Like I might not always be comfortable to pick up, a completely vacant building with the windows bashed in and like it, that kind of thing. But maybe I pick up a deal that's $200 to $300 below market on all the rents. I can make some improvements. So people have to decide like what level of renovation that they're willing to do. So if you're newer, probably go for the latter. But I think it's always good to look for a value add. I mean, honestly, the only people that I see not buying value add are like doctors, attorneys, like people who need write-offs, right? Like they're like, I don't need cash flow today. My plan is to buy this turnkey property, pay it down over 15 years. So that way I have cash flow when I retire. And now they have all these write-offs.
Fourth quarter of their life, and they're trading from a crappy property, and they're like, we don't want to do the work. We're 70s. We're tired. We want to go road travel. They're parking it into our buildings. We're selling. It's done. It's market rent all done. They're like, just buy that. Because you're done. You're out.
Opportunities in multifamily, I'll say even for multifamily, inventory is still super low and stuff's not really moving because nobody can really determine what are cap rates today. Does anybody know? Nobody knows. We're kind of in transition. I think we're kind of in the midst of them going up a little bit. So I think everybody wants to see where rates kind of shake out before they start making big decisions. That said, there are some guys that are, more aggressive and they're buying properties. And like you said, they're all the value add stuff, because the thing is that if you buy right, there's a lot of room in the project. That's why I've always loved real estate and commercial multifamily the most, because there's really a lot of room for error. Like I always say, like you have to be pretty bad to screw it up. Like with apartments, like there's a lot of room. You can make a lot of bad decisions and still come out smelling like a rose.
I agree.
Management.
I agree. Well, let's talk about the multifamily asset class, because I find it kind of interesting. It is a very, very low risk asset class to invest in. You guys touched on it. It's evergreen. There's never going to be a replacement for two things: a place for people to sleep and a place for people to store their belongings. That's never going to go anywhere. And if you look at a lot of businesses and companies within the world, they boom and they bust. The Kodaks, the BlackBerrys of the world. But with multifamily apartments, that's always going to be there, right? And so there's a lot of good with it, but I kind of feel like over the years, there's been a lot of demand for multifamily. There's been a lot of educational platforms out there where everyone's teaching anyone, hey, if you're sitting on the couch doing nothing, I can teach you how to raise money and become an apartment syndicator and go take down these big deals. You got the Michael Blancs out there, the Jake and Genos, all these guys, Brad Sumrock, that they're putting out all these groups, and they're basically breeding all these people to go buy apartments. And so I think that has made it even more overheated. Cap rates are super low. And I feel like over the last decade or so, a lot of the value add multifamily properties have already been picked up and renovated. Not all of them, but a lot of them. And so where do you guys kind of see multifamily going and navigating over the next few years? Do you think we're going to see operators pivot out of that asset class, or do you think we're going to continue to see it stay hot? Hey guys, real quick, I hope that you're finding value in this show. If you could do me a huge favor and drop a 5-star review on Apple Podcasts or whichever platform you're listening on, it would mean the world to me. Also, if you know of anyone that would potentially potentially benefit from this podcast, feel free to share it with them so we can help more people build wealth through real estate investing. Now back to the show.
So I think there's always going to be a lot of demand for apartments. And that to your point, that's why the returns have dropped so much, is because people are realizing that it is a super safe asset class. And now we have more competition because of social media and all these people, really promoting this and having courses and coaching and all this around buying multifamily. So there is still opportunity. I think people still want those safer returns. But I always tell people, when you get into multifamily, this is a long game. Like, you might get a home run, but don't count on it. Like, this is just like a super stable, it's like buying a bond or something.
Annuity.
You know what I mean? Like, it just keeps giving you the cash flow. It's very reliable. It's very stable. So that's the way I view multifamily. That being said, if you're looking for a higher return with less risk and you have experience with rehab and construction, one thing that I think very few people have jumped on, I know one person in particular that's doing this and making a freaking killing, is buying hotels at the right price, very cheap, and converting them into like apartments. Essentially, they're basically going and they're getting a special use permit to convert it to an SRO, or they're converting to apartments. So taking, like, for example, you go down to like a Chula Vista and you see some old Holiday Inn, it's tired, it's broke down, and you're like, who the hell's going to stay here?
Right.
That hotel comes up for sale. You buy it at a discount because it's just so underrun. You go in and you get permits to convert it to residential. That is a big business. That is a huge opportunity. It's a very niche market. And the person I know is making a killing doing this. And so now you bought an asset, like maybe not everybody has the appetite for hospitality. It could be, higher maintenance. It could be something you're just not familiar with or comfortable with. You think it's risky. Financing is a little bit trickier.
It's a lot more day to day.
For sure.
Yeah.
So then you say, okay, fine, I don't want to do that, but maybe I could just go buy a hotel. I convert it to a residential use.
Yeah.
Now I picked up a deal for $140 a door in San Diego. That's a joke, right? You could never find anything like that. Put some cash into it. Maybe you're all into it for $180, $200, something like that a door. And now you have an apartment building that's cash flowing for you.
Yeah.
Not only that, you're kind of like helping, like there's this big issue about, tenants' rights and the tenant ordinances that are all coming out. So now you can participate with all these programs to help, house quote unquote homeless people and things like this. You can get HUD, they pay your rent every month. This is a huge business because now you've taken a riskier asset class, converted it to the safe asset class, but you got a huge gain because you're willing to do the work to convert it.
Yeah. I love that. I've seen some SRO stuff out there. What exactly is SRO? Because these are typically long-term, from what I know about it, long-term agreements with, is it the city or the state, to where you can operate and you're basically providing affordable housing, but you have to do it for X amount of years. Is that accurate?
That is right. Actually, the very first building that I financed in 2003 was an SRO.
Really?
That is still here in downtown.
What are the chances?
By the ballpark. And an SRO is basically a single room occupancy is what it's called. Okay. And in a lot of SROs, a lot of times it's just a room. It may have a kitchenette or a bathroom, but a lot of the units have like a communal kitchen or bath or both. Okay. So I've financed a handful of them. It's a super unique property type. It's usually a month to month, like 30-day agreements. We've managed some. And when we had the management company, I will tell you, it's a lot of people who just got out of jail. It's people who just, were homeless and this is what they can afford. So like the clientele for that is definitely different. Yeah. But it is also like a very profitable business because it's kind of like in between running short-term rentals and like long-term rentals, because a lot of people end up staying there for a lot longer than 30 days, but it's really like a 30-day contract. And the cash flow is great on those. I think those are really great. There's less and less of them here because people are trying to convert out of those, but the city really wants to have them because it is like the most affordable housing you can have.
So here. Do they, as an operator, do you get a kickback from the city?
No.
Because you're basically locking this in for like 30 years or something like that, right?
No, you don't get any kickback from the city, but you're buying at a lower price point than you are multifamily. So there are like the cap rate is naturally higher on those buildings than a traditional apartment building.
It's more work for management too, because you're probably more turnover, dealing with more issues. Plus, like they're sharing a bathroom in this. It's like it broke or it needs to get cleaned or, you're dealing with it all, right? So
I wonder, did the SRO tenants, did they get subsidized from the city in order to qualify to
Some
stay
of them,
there?
not necessarily. Anybody can stay there. Yeah.
Okay.
So you can either participate with city programs or not. It really is kind of like multifamily in that sense. Like you can just rent to anybody. And it is very difficult to get rid of that. Use or designation. We have a friend and a client who converted an SRO that he purchased unpermitted, of course, and then the city came out and he had to convert everything back. It was like super risky.
Oh man!
But the city wants to keep the SROs. They want to protect them. And what we've learned is like city council members have a completely different way of thinking than we do. So they want to keep those SROs available because it's affordable housing for the community.
That makes sense. So speaking of affordable housing, we know, in California, in order to address the housing shortage, they put a lot of ADU policies in place. And I know here in San Diego in particular, there are lots where you can go in and buy a residential lot now and potentially put up to 4, possibly split it and put up to 8 units on one lot now. Do you guys see this as a big opportunity moving forward?
Yeah,
it's because we work with so many real estate investors, the ADU thing has been huge.
Yeah.
I will say transparency, what a lot of people don't know is when you're doing it from 1 to 4 units, sometimes there's issue with financing because the lenders are kind of not sure. Finally, Fannie and Freddie gave some guidance on it because they do majority of them. At first, they're like, no. And it was kind of like, what do you mean, no?
Yeah.
So you're the government. You want to save housing. You're telling us no.
And it's permitted,
Yeah. So then they started easing up. It's getting better. Because I think there was just like, especially in a place like California, there's so much pushback to Fannie going, what do you mean, no? Like we got to encourage this. And the other thing is, which is a bummer, and it's kind of out of everybody's control, is on 1 to 4, you can have one appraiser. Let's just say you bought a house and you built an ADU in the back. It's not a unit, it's an ADU. An appraiser can go out and it costs you $300,000. He can go out and give you, okay, this is worth 200. You're like, excuse me? And then another appraiser comes down and says, oh, it's worth, $350. So if you convert a garage or this, sometimes they really, one appraiser can whack you on the value, another one sees the value. What the cool thing is if you do it for a 5+, you're just getting the price per door.
Yeah, price per door.
So we had a 29. We have a 29 unit in National City, and there was an office that was just converted a long time ago. That was just a studio, and we basically Krystle got the plans, permits done, went to the city. It took forever. But
it cost maybe, I would say, $20,000 tops to do.
And when we got the appraisal done, he gave us the $265 a door, whatever the hell is worth. So that was huge. So I always tell people, if you have 4 units and you were to add the 5 or 6, like you said, or more, you're going to probably get the price per door. And those appraisers, it's just a little different. They're like, they don't get, it's like, they're not, I feel like these appraisers get emotional about it because I've seen these debates and these webinars. I'm like, this is ridiculous. These guys are just like, price per door, here's the rent, here's the cap rate, there you go. And so that's why I like commercial more.
So simple.
Yeah.
So, but ADUs, massive, I would say over the last year or so, a lot of people turned to that. A lot of people making a lot of money, massive opportunity there. That's like Krystle said, San Diego, they want housing, they need housing, they're pushing housing. This is coming from the state level. So ADUs, as far as we know, are going to be,
the big thing for a while.
For a while. And it's like you said, we're not making more land. We have land. So what we have, we have to make the most opportunity out of it.
Yeah, I love that. And I always tell people, like, the cost of construction and renovating property, generally speaking, is going to cost me the same whether it's a property in Oklahoma or a property here in Santa Barbara, California. But I know we're going to create a lot more equity by renovating or building an ADU in Santa Barbara than we are in Oklahoma. Let's be honest, right? Yeah. And so for me, I would rather, do projects out here in hot coastal markets. But it's like you said with the appraisers, it's very subjective. I remember when I bought it was a 2-unit property in Linda Vista. It was a single family with a brand new ADU in the back. And I actually got it on a primary residence loan where that lender actually doesn't finance 2 units. But the appraiser basically we just said, hey, this is like not even a granny flat. We just said it's an in-home office, and they checked it off, they financed it. But then I could take that to another appraiser and they could say, hey, it's 2 units. So it's very, very subjective. But it sounds like now, this is a few years ago, now the ADU thing has been around for a little bit longer.
You're getting comps.
Yes, we're getting comps out of it, which is big.
Yeah.
Yeah. So right now we're doing with that property, we're about to shut it down. It's been like 15, 16 months from the city to get permits for these ADUs. I know they say, it's very quick. But it's been 16 months and we're still not to like final stamps. We should have them very soon. There's been some back and forth, but we're going to convert the garage into a 3rd unit. It'll be like a 1-bedroom, 1-bath apartment. So it'll be interesting to see what that does to the valuation after. I know it's subjective, so I might talk to 3 appraisers and I might get 3 different opinions. So that will be interesting to see.
It's funny, I'll jump on something.
Yeah, go ahead.
We learned this yesterday. So we know one of our good friends, investor here, big flipper. Same thing. He's trying to get this, and he said the mayor of LA, she's going in there attacking the homeless problem, attacking we need more units. And so she basically kind of said, like, what are all the bottlenecks that's going on? And obviously builders are like, well, it takes, a damn decade.
Yeah.
So she came out with this rule saying it's like you have 30, 60 days. You either approve it or deny it. So this whole waiting around 16 months, no. It meets it, approve it, let them go. So hopefully that adoption goes there and goes here, because that is the problem is this is why builders don't like California or San Diego. It's not that who doesn't want to build here. It's that, dude, we can't get anything done.
Yeah.
We were at an event with Jonathan Siegel recently, our friend put on, and he was talking about, like, I just want to build things. And the guy that has all the restaurants that developed all the born and raised, all that. Yeah. He was like, yeah, you know him. He's like,
got his name all over the neighborhood there.
Yeah. He's like, I'm just trying to get this done. I go get the plans done, and all of a sudden some city council walks by and goes, I don't really like that roof. And he goes back and he has another meeting. He go, we need to change the roof because if a plane runs into the restaurant, we can only have so many people killed, not the whole top. He's like, well, wait, what? Like, after he got approved, it was already $4 million into the build.
Wow.
So he just says it's this type of, and he just says, but the opportunity in San Diego for him is like unbelievable. You know that because it's such an amazing place. He goes, but if we could figure out this gridlock, like, Krystle's on a panel years and years ago with a lady that's a part of a big developer. They do $500 million a year. And she's like, we would do $2 billion a year. We're like, why don't you? She goes, we couldn't get it through. As good as we are, we're the best. We can't even get the projects through.
Yeah, you're right. The bureaucracy and the red tape here in California has always been a challenge. New York is very similar. But with the restrictions and the regulations, if you can figure out a way to operate in most of these markets that are tight, it's actually going to bring more demand to your properties. It's actually going to be a bigger lever. And so we're seeing some of that. But man, I love San Diego. I'm so bullish on it. I think if you look at the 4 major markets in California, you got the Bay Area, you got Los Angeles, Orange County, and you got San Diego. You could argue San Diego has the best beaches. It has the best climate. It has the most chill vibe.
We have the most upside, for sure.
The coolest neighborhood. We don't have a ton of traffic. Everyone's very chill. I think because there's a lot of implants here, everyone's just really laid back.
And out of those markets, we are still the most affordable. So that gives us that much more room to run.
100%. The most affordable. And then in addition to that, like from a geography perspective, the way we're positioned and located. To the north, we got Camp Pendleton, so you can't build out there. To the west, you got the Pacific Ocean. To the south, you got the Mexican border. And then to the east, you got mountains. So there's only so much supply. And I feel like now with social media and the way everything is going with all the media these days, the cat's out of the bag. And we're seeing tech companies move down here from the Bay Area. So long term, I'm very bullish on San Diego. And I know you guys are too.
I agree. And the other big thing why San Diego will probably never be crazy is Camp Pendleton. I tell people, a developer told us a long time ago, think about if that land was not owned and what you would have to have a major city here to deal with all that. Yeah. So that Pendleton, all that land really isolates us down here. I'm almost like, can we be separated our own little
it's like an island.
And one thing I was going to say is when you asked about multifamily is Krystle and I you know, we know like the Brad Sumrocks well. We know a lot of syndicators and staff because we interviewed.
Yeah.
We've looked at deals all over the country. We went to Miami, lived there for a month. We drove 80 properties, talked to brokers. You know, Krystle sized all the deals. I go, okay, Krystle, what did you discover? She's like, okay, besides our red tape here, besides rent control here, and it might go in other places. They say no, but you're like, it was always it eventually came here. I'm not seeing
Cap rates are the same. Returns are the same.
Yeah.
But here was the difference. Name a Brad Sumrock, I'm not gonna say all of them. 90% of the real estate investors that we know that syndicate stuff, they're like, yeah, we don't buy in California. And you go, why? They're like, well, because this, that.
It's not
and
landlord
when
friendly.
I talked to Brad Sumrock, I was one-on-one. He goes, honestly, guys, I don't even know the market. And we tell him like our returns and, you know, like Nick and stuff. He's like, what?
Yeah.
And so we said, you know the difference though? He goes, what? I go, when we went to Florida and stuff, they're like, we have international buyers, we have Wall Street buyers, we have this buyers, this. So when you list a 100-unit deal, there's 80 people, but it's all over. When you list a 100 deal, we'll tell you who's going to buy it. I will tell you the local person. So the competition's with among us.
Yeah.
It's not outside because they're scared. And like you said, it keeps us isolated, but we know what we have here. And they're like,
honestly, I'm like, great. Keep thinking California's the worst.
Right.
Like that's fine by me because
Right.
it just eliminates a lot of competition that we would have. Like I can't imagine going and bidding on a deal with like 80 other people. Like that's insane.
Especially people out of state.
Gosh.
You know?
and they're like, to just get us to accept your offer, the guy's like, on this deal, you're going to need $1 million hard. Like
Day
literally
one.
from day one. You're like, what?
There's even people I know that live here in California and they won't invest in here.
I know.
And like, how come? They're like, it's just too expensive.
I was in the Sumrock group.
Yeah.
And there's a handful of other Californians and even San Diegans.
Yeah.
And they're like, oh no, I live here, but I don't invest here. And I'm like,
Some of them sell real estate. I thought it was funny.
it's the craziest thing to me. I'm like, are you serious?
Yeah. I love it here. I mean, everything I've bought here has performed very well. Even the short-term rental stuff here. We're in like 8 or 9 markets around the country right now in the short-term rental side and hospitality. San Diego, it's clear cut, number one. These properties just stay booked year round. We don't have to push and pull on them. They just run smooth like butter. And so I don't get it. I don't understand why people are missing the boat.
People come here a year.
Well,
35 million a
35
year.
million
Think
people
about
come
that.
here.
And to
It
be
brings $12 billion in revenue for San Diego.
And to be honest, I get it. A lot of people were investing out of state because they were getting higher returns, like not necessarily building equity or the appreciation, but they were getting higher, like just cash flow more.
Yeah.
But if you talk to anybody that owns in Texas now and some of these other places that were well known for being cash flow states,
Yeah.
it's
That's a good
changed.
point.
It's more like California.
Yeah.
So now you're, now you have to buy deals and like look at the upside and maybe you're not going to get as much cash flow, but you're going to get more appreciation. Like they're all dealing with the same type of investments now that we are. So now I'm like, I'm not going out of state. And then plus I realized like, yes, I want the cash flow, but you cannot beat the appreciation that we get here.
You cannot.
Hands
and that's
down.
never going to go anywhere long term.
Right.
Yes, it might go up and down in the short to midterm, but
Yeah.
if you can buy well-located assets anywhere in coastal California and hold them for 10, 15, 20
Value's
years,
going up.
Come
you're going to
on.
make more money than God.
Yes.
Yeah, and it's funny when we were at so some of the guys the finance guys that do a lot of Brad Sumrock's deals, we were there doing a bus tour. So we went there and it was James Ng and we were talking to him and we were talking shop.
Yeah.
And I said, hey, so what are you doing for a loan? You'll like this because this
Yeah.
is getting to the point.
Yeah.
Because it's all these guys that were like, oh, we're going to syndicate in this. 80% of his deals were bridge loans. So the guys on a podcast recently, hey, what's your deal thing? 80% is conventional. So all the guys, they basically said, like somebody made a joke. I don't know if it's Grant or Michael, it might have been Michael Becker, was like, basically anybody that syndicated that did the bridge loan model, they're out of a job. And they can't buy because right now a bridge loan is probably 50 to 65%. The rates are high. So those people that were doing it, it's not available.
Yeah.
So you're like, well, who's playing in the multifamily market? It's, we were talking to Pace Morby. He's going to buy a $100 million deal, right? He's going to put 40% down. He's going to raise the money. So if you can't raise 40, 50% down, you're not a player in this market for those massive deals.
Yeah.
So the Grants and all those guys, the big guys, they know that because the financing sucks. And on top of that, they might do some weird financing because do you really want to get locked in on a high rate on a 10-year 10-1 arm that's at what, Krystle, 6% that has a yield maintenance prepay where you want to refi into yours. So it's a very tricky market for those big guys. And so that there's just, we'll see the opportunity, but it's so, and those guys, they don't come here. And it's funny because Krystle doesn't do really the agency debt here. The lending in California, the availability,
so competitive.
I don't know New York well, but I would put us up against anywhere in the world, especially the country. The amount of banks we have here and stuff, it is insanity. You can go to like a Texas, there's like 3 banks. Here, there's like 30 banks that do it. So our debt market, our lending market here is, man,
like you don't have to rely on Fannie and Freddie for financing. There's lots of other options.
And is that because those lenders see San Diego and some of these great coastal markets in California as less risk? Is that why?
For sure. Yes, because it's all different risk profiles. So for example, we do a lot of business with Union Bank. They forever ago, they lent in Texas. But then they stopped. Why? Because Texas is like heavily reliant on their oil market. So, hey, if oil's not doing good, the economy's not doing good. So they have much bigger swings. So for example, vacancy in Texas, they generally run at like 7 to 10%. Here it's always 5%. But the problem is if the oil market's not doing good, then the vacancy shoots way up. Here we're like consistently, I mean, they use 5%. Our vacancy is actually closer to like just under 3. So, and it like never changes, you know? So things like that, it's like more reliable for a bank. A lender can just go, oh, great. Like California or San Diego's always running at less than a 5% vacancy. So I can rely on that. But of these other places that are heavily reliant on different factors and industries, these kinds of things, they're going to be more risky. So I have a higher risk of my loan going bad. So that's the way banks look at it. And so California has become a very easy place. There's just like any lender who's lending is pretty much lending here.
And look at like New York, you know, Ryan Serhan, obviously you've heard of him. And so Q4 for New York, the residential market, the sales were down 29%. 55% of the sales were cash.
Wow.
So Ryan Serhan says, when the stock market's down, I can't sell a $50 million condo. But when the stock market is rallying, I will get calls saying, hey, I'm ready to pay all cash. What? So they're like this with the market. So when the market's like this, he's just like, this is crazy. So fourth quarter was rough and then the market's down and you're seeing that. So you look at California and San Diego, like Krystle said, it's like, I know San Francisco's, I feel like that's more how they politics up there. That's why people left and they're having to deal with how they ran their, you know, their economy, their community up there.
Of course.
Same with LA. They're dealing with the pain. People are like, we're going to leave. But otherwise, California, it's like you get a little bit of volatility. But you said if you make it through, it goes out, you know? And then so when we went through the mortgage meltdown last time, a guy that owns a massive lending company came in and talked to us. And I always remember this. And this is always like, I don't care if you're an investor, you're in real estate, mortgage, you know, these are the time, and this isn't even like last time to me, it's not even close, but he's looked at us and said, you know, if you can make it through these times, on the other side is you're showing up to the gold pile. And 2020, 2022, you couldn't even see the pile. There's so many people. You show up, you're like, where is everybody?
Right. No, absolutely. And I think, you know, for all the people that were on the sidelines the last 5 years waiting for this to happen, well, now the time is here. And there's going to be a lot of opportunity out there in this year, in 2024, especially for those who are creative and are willing to take action.
This is where you add a 0 to your net worth. You know, like this is the time to do it. And like you said, you're going to see some people come out of the woodwork who've like just come out of the cave. You're like, who the hell are you? And I'm like, oh yeah, they were here last time. You know, because like we have a lot of people who've literally just been on vacation for the last 5-7 years. They're like, I don't buy in this market.
You guys
living off cash flow, literally. Like the typical. They don't have to be massive. They just got the cash flow, and they have taken advantage of these 4 or 5 opportunities in their career. They buy heavy, and then they're out. And they go. It's funny, and they're not trying to get big. They're like, I just pick up, like Chris says, maybe add the other zero, pick up a little bit more. And
I mean, in my opinion, this is where business gets a lot easier in many ways. Yes, financing may be a little bit more of a hurdle. Like it's super easy when the market's frothy. Like financing is the best, right? Low rates, lenders are getting more aggressive. Okay, fine, you deal with that. But you're picking up deals that you would have never had a shot at in a market like that.
Right.
Some other guy that had a bigger net worth, that had more of a name, he was buying that property over you.
Yeah.
So now is your time to get in and buy some of these properties. Like you said, get creative, do a little more work a little harder than you're used to. But this is where you're getting the output. Like you're getting the money back for the work that you're putting in.
Yeah.
For sure.
Yeah.